Thank you all so very much for joining. It is August 4th, 2025, and this is our Monday Morning Touch Point, where we are going to go over the single best leading market indicator available for the entire area. Let's go ahead and get started, you all. This is where we take a look at all of the new listings, all of the price increases, price drops, back on the market, active under contract and pending. I went ahead and updated all of the previous weeks. So all of this is fresh. All this is good to go. Let's do a really quick recap on what happened 2 weeks ago, 3 weeks ago, and then we're going to update what happened over the past 7 days. Now, you can see that the ratio has improved. I would even go as far as saying dramatically over the past few weeks. We bottomed out at a 0.67 between July 7th and July 14th. We then went up to a 0.75 and then at a 0.79, which is really encouraging. Year over year, it's still off because last year, that same week last year, we were at a 0.90. Before that, we were at a 0.84 as opposed to a 0.75. But here is one thing that I am very encouraged. Take a look at these positive numbers. We had 4 weeks in a row. This is from June 23rd all the way through July 21st, where we had more properties going under contract this year as opposed to last year. But let me ask you a question. If we had more properties going under contract, why is the ratio under last year's ratio? Well, I'm glad you asked the question. The reason why is because we also had way more new listings entering the market, which is why the new listing to pending ratio is so powerful. Because if the only thing that we do is we focus on what's going pending, we're going to miss out the reality of the market. And it goes both ways. We had a situation not too long ago where we had less properties going pending, but we had way less properties that were coming on the market. So therefore, we had an improvement on the ratio. And that's why we're focused on the ratio. Right now, it's the opposite. We had 4 weeks in a row. We reversed a little bit last week or 2 weeks ago, and we're going to see how the numbers play out this past week. But we had 4 weeks in a row where pendings outperformed pendings last year, yet the ratio did not outperform pendings because of new listings and back on the market. But good news, only down by 69 2 weeks ago. That's only 6.5%. That number is going to improve a little bit over the next few weeks. It will still be in the negative. It's going to be in the negative around 20 or so. I do expect another 40 or so properties get labeled as pending, active under contract over the next few weeks. We all know that agents, builders are really bad when it comes to updating the MLS. And that's why we can say that this number is going to improve. It is not going to beat last year. Last year was a very good week, this same week last year, 2 weeks ago last year, where the ratio went up to a 0.90. Last year, the ratio was 0.82. So let's take a look at what the ratio is for this week. We are going to start by taking a look at all of the new listings that have entered the market. On the new listing side of things, keep in mind, this is the 6-county area. Travis, Williamson, Bastrop, Hayes, Caldwell, and Burnett counties. We're going to go from the 28th to the 4th. Last year, we had 1,002 new listings enter the market this same past week last year. Right now, already at 952. We are going to beat last year because we are down by only 50. In between now at 10:09 a.m. all the way to 11:59 p.m. tonight, we are going to get more than 50 new listings entering the market. So it's going to beat last year. It's going to be on the positive side. And you can see that we've been on the positive side. Matter of fact, we only had 1, 2, 3, 4. We only had 4 weeks out of how many? Going all the way back here, 4 out of, what is that? 30. 4 out of 30. We were negative. 26 out of 30, we were positive. We had more new listings come in the market compared to last year. Let's take a look at price increase. We are at 167. take a look at price decrease. 2,047, 92%. Not bad. Better than last week, better than 2 weeks ago, better than 3 weeks ago, 92%. We are looking at here, let's take a look at back on the market, 230. Well, that's a high number. 237 back on the market, 25%. Highest going all the way back to June 30th. 25% back on the market. Active under contract, 392. Not a bad number, 392. And this is where you get to guess. I need 5 guesses for the pendings. 5 guesses for the pendings. Go ahead and please give me 5 pending guesses. 5 pending guesses. Okay, we've got a few people starting. Thank you so much. Harold starting us off at 230. And then we're going to go with Seth at 266, Melanie at 246, Sonia at 239. That's going to give us, let's just do 2 more guesses or 1 more guess. Go ahead and just give me 1 more guess, 1 more person. Go ahead and just write down your number. And let's just see. We've got we've got 222. Love it. Let's go ahead and just click on the pending. And let's just see. We've got 266, 246, 239, 222. The number comes out to 249. 249. Not bad. Not a bad way to start the day. Now, it is a 0.54 ratio right now. And we know that with a 0.54 ratio, we're going to get very close to the 0.7. Now, last year, we had a 0.82. So we're back to that. This time around, we're going to overperform on the new. We are going to make up that 50, but we are down 365 on the pending compared to last year. I would say that we're going to be negative. Just like this time around, when we updated 2 weeks ago, we are negative 6.5%. This number is going to improve by about 40, which means we're going to be negative anywhere from 1.5 to 2%. And when we update this information for this past week, we will still be negative. We're going to be negative on the single digit, high single digit, anywhere from 8 to 9.5% or so will still be negative. So we are going to be trailing last year on that weekly new listing to pending ratio. But we were starting off at a 0.54. Now take a look at open house. I did update this earlier in the day. 3,291 open house. I am noticing a lot of open house signs out there. But here's the other thing. A different mindset is going on with open house. You have one agent that's doing the open house almost in a like mad kind of way. It's like, I just have to do this dreaded open house or else I'm going to get fired from my listing. I'm just doing it as an obligation. I just have to show my seller that I'm, begrudgingly doing this just because I'm told or this is the expectation to do this. And then you've got the agent that is doing it cheerfully, quickly, completely just excited with enthusiasm saying, wow, I get to do this. I get to do this open house and I cannot wait to meet potential buyers while doing this open house. Let me ask you a question. Does that make a difference? Does that make a difference for that person walking in? You see, I love going inside open houses. They have no idea who I am. I don't make the introduction. Oh, by the way, I've got a license until after they make the introduction. And you can tell. You can tell within 10 seconds of walking into the property if they are agent A or agent B. The agent that is just wishes that they were not doing it. Here's my recommendation. Don't be the agent A. You're better off not doing it. You're better off not doing it. Just if you don't feel like open houses work to sell the property, I'm not going to disagree with you. The data shows that it's not. So that's okay. Communicate that to your seller. Get someone else to do the open house. Pay someone else to do the open house. But don't waste your time. Don't waste the time of the people walking in. It's going to make a difference. Either be that agent B or just do not bother. And here's the thing about that agent B. It is a choice. That agent is making a choice to have enthusiasm, a choice to show that, they're excited about the area. They're excited about the property. They are equipped. They have the information. They're eager to answer questions. That is a choice. That agent is choosing to have enthusiasm. So that is my recommendation to you or anyone else listening to this. Make a decision to be that agent that is enthusiastic, that wants to do that. Let's go ahead and take a look at the monthly. What I'm going to do here is just make sure that everything is updated for the monthly side of things. And we are looking at, on the pending side of things, 1,632. Let's go back 1 month for June, and that's going to be 1829. Okay, good. Let's go to July, active under contract, and that's going to be 2132. Let's go ahead and take a look at June, active under contract. Make sure everything is perfect. 2075, that's good. And now what I'm going to do is take a look at the sold. I have to go to a completely different screen to access the sold. Give me 1 second. We are at 2931 or 2391, 2391. Let's go ahead and go to June to make sure that we've got all of the correct sold information. That's going to be 2953. And because we updated June, let's go to May to see if any agent updated a sold for, okay, that's 3104. That is all good to go. Now, let's take a look at the year-over-year comparison for the month of July. I am not going to add the August data until we are, well, what is this, the 4th? I usually don't do it until we're about 7 to 8 days into the month. Right now, very limited data. It's just not, the data is not going to matter. Right now, we're only 4 days. And a majority of that was a Friday or was a Saturday and a Sunday. So the data is going to be incomplete. So we're not going to update the August until next Monday. I will have the August data, and then we can start forecasting what the month of August is going to look like. So let's focus on July. And on the active side of things, we have 15.8% more active properties. We ended July with 15.8 more active properties compared to July of 2024. But take a look at the new. The new is really interesting. For June, we had one less new listing compared to June of 2024. So that's not even that's 0.0001. And right now, we've got a 12.2% increase on the number of new listings for the month of July 2025 compared to 2024. 199 more price increases, which is really surprising, but 1,467 more price drops. 85 more back on the market. This is the encouraging part. Look at this. When you compare year over year, take a look at this. We've got 3 months in a row with a positive on properties going under contract. That's huge. That's really encouraging. We had a 1.8% increase on the number of properties going under contract compared to May 2025 versus 2024, 1.6, and then a 0.9. This number is going to improve a little bit. That 53 is going to go up to about, or 33 is going to go up to about, I'd say 60 to 70 or so. So that's going to be right in line with the difference that we saw both in May and June. So that's the good news. We are outperforming last year on properties going under contract, even though rates are just about the same. But we have noticed an improvement in pricing, especially on the median sold price. So we are seeing an improvement on that. And then builders. Buyers right now can get better deals from builders today than they could in July of 2024. So that's driving the market. We're going to talk about the activity index, new construction, as opposed to resale to show you how much the market is being driven by new construction. On the sold side of things, because we had 2 months back to back with an increase on pendings, take a look at the sold, a 3.7% increase for the month of June, but now we are down 14.9%. We had a very slow July when it comes to sold properties. Well, let me ask you this. Out of the past 25 years, where do you think July of 2025 falls on the drop month over month? out of 25 years, past 25 years, the worst, second worst, third worst, top 10%. What do you all think? Which top 10% is like second worst. So right down the middle, where do you think it falls on the percentage drop month over month on the number of sold properties? What do you think? Go ahead and just give me an answer. Write it down over chat. Where do you think it falls? Worst? Okay, the worst one. Very close. The second worst on record. Going back 25 years, the month over month drop on the number of sold properties is the second worst on record. The only other one that is worse, I believe it's going to be like either 2009 or 2010. So month over month, we had a significant drop. This is what happened. A lot of the builders pushed their closing to the month of June, May and June. It's like, get this closed in May and June. We noticed a pretty substantial bump on the number of sold properties, new construction sold properties in May and in June. And then we had that pullback for the month of July. That is why June had a 3.7% increase, because some of these properties right here, you see 11.9, 9.7, 10% increase. These properties that were new construction properties, guess when they closed? They closed some of them here, some of them here. You have the properties that are, ready, move-in ready. They're spec homes. They're ready to close in 30 days. And then you've got the properties that won't be ready for 3, 4, 5 months. That is why we saw that 3.7% increase. A lot of new construction builders are doing a great job pushing inventory as much as they possibly can. Let me go ahead and just save this really quick and just lower. I'm going to go ahead and close this out. And let's take a look at inventory. We are slightly up compared to the Friday data. We are up right now 67 active listings. We have 17,697 active. That is a gain of 67. We are down week over week 231. We're down month over month 69. We're now entering that phase of the market. Real estate is cyclical, where the number of active listings already peaked, and now it's going to be a drawdown up until December, January, and then we're going to start picking back up, and then we're going to maybe peak again next June, next July. But we have that natural transition when you look at inventory, which is why we are obsessed with the new listing to pending ratio. Because guess what the headlines are going to say between now and January? Inventory's down. Active listings are down. True, but it's cyclical. It's the reality of the market. We need to be concerned about the activity index, the new listing to pending ratio, because if inventory is down, which it will be down between now and January, but the new listing to pending ratio is still hovering around the 0.65 to 0.75, what is it that we have? A tangible buildup in long-term inventory, because demand is lagging the new inventory that's hitting the market. That's why we are obsessed with those leading indicators like the new listing to pending ratio. Year over year, we are up 16%. Here's the continued encouraging news, and that's going to be on the pending side of things. We have 4,295 pending properties. That means that we are up 2.5% year over year. That will give us an activity index of 19.5%. And we've had a few 19.5s. We had July 25th, 19.5. We had the 18th, the 18th and 21st, 19.5. We had the 7th, 19.5. But we are hovering under 20% on the activity index, which is the pending divided by the active plus pending. And we've got a 6.3 months of inventory. Now take a look at the activity index for resale compared to new construction. Resale accounts for 3/4 of the market, 75.7% of all of the active listings on the market are resale. And yet it accounts for 62% of the pending properties. And that's why the activity index is 16.7. Whereas the new construction only accounts for 1/4 of the market And yeah, it accounts for over 1/3 of the pending properties. So the activity index across the entire board is 19.55, but on the resale side of things at 16.7. What else can we glean from this? This is the activity index along with months of inventory. Let's keep on going. Active listings, you can see that we had a big drop off whenever we transition from July over to August, a really big drop off right there. A slight increase. Pending listings, take a look at pending. Yeah, so that's active. We are up 16% on active. On the pending, we're up 2.5%. And take a look at the activity index. We started noticing an improvement, and now that's back down a little bit, just down a little bit. Months of inventory, we are up 17.2% on months of inventory. And here is your natural market cycle. And there we have it. This time it peaked around November. And then 2024, it peaked around July. And then right now, it peaked in June. And that's just the normal cycle. Peaks, peaks, peaks. So we're now going to experience this drop right here all the way to when? When does it start going up? January. Then the market's going to start picking back up with inventory. Of course, unless something happens that as of now is unforeseen. We do not know what's going to happen between now and January. Right? If you ever want to tell God a joke, just tell him what's going to happen tomorrow. We have no idea. We don't know if the Fed's going to lower rates. We don't know if Jerome is going to get fired. We have absolutely no idea. We don't know, and honestly don't care. Really don't. We are responding to these events, not driving these events. We just have to understand what is going on. But a lot could happen between now and January. We can see that in 2024, active listings peaked in July. This time around, it peaked June of 2025, June 30th. It peaked at 18,146, and we are 467 listings under that. And there is a more detailed line graph showing when we peaked this year as opposed to last year. Out of all of the active listings, this is another good news. We got up to 60%. At one point, not too long ago, a few days ago, 60% of all the active listings had experienced a price drop. Right now, that number went down a little bit. We're at 58.7% of all the active listings have had a price drop. And you can see the breakdown of the municipalities, the cities that have the highest price drops. Let's take a look at activity index. And what I want to do is I want to look at the historical activity index. City of Austin is down by just a tad, but Bastrop is up. We've got Buta's down a little bit at 30%. It was at 30.8. We've got Burnett down a little bit. Cedar Creek down a little bit. Look at Cedar Park. I've been talking to some of you all doing open houses in Cedar Park. And you're like, Dan, I just don't understand. I was doing open houses in February, March, April, and I was killing it. I had a ton of traffic. Everything was great. And all of a sudden it hit a wall. There you go. The data shows that. We now in Cedar Park, we have the lowest activity index going back 1 year in Cedar Park, down to 19.3%. This trend line is over the past 1 year. So this trend line plots this entire data point. So this goes back 12 months. Good question. And then the dot on the trend line will show you the peaks and the valleys. So one dot shows you the bottom, another dot shows you the top. Does that answer your question? Very good question. This is a 1 year trend line. 1 year trend line. We've got Lago Vista is seeing some improvement. That's good news. We saw some improvement in Lakeway. Lakeway bottomed out at 11.1%. It's at 14.9%. That's really good. Yeah, let's take a look really quick. We've got Hutto. Look at Hutto. Okay, interesting. Hutto all of a sudden hit a wall. We've got almost half of the activity in Hutto that we did a year ago. September, we had 39.9% activity index. Right now, we're at 20.2% in activity index. As the activity index slows down, what follows? Months of inventory. So what can we say right now? Months of inventory in Hutto will start going up because we've got less properties that are under contract in relation to the properties that are active on the market. That is a leading versus lagging indicator effect. We've got Kyle doing very well at 32.6. We've got Buda, Buda and Kyle, you're absolutely right. Continue just to outperform the entire market. I cannot see a single one that reached a peak. We've had a few that bottomed out, but we do have some improvement. Liberty Hill just hit a bottom. Manchac, that has seen some improvement, so that's encouraging. And let's take a look at zip code right now. Let's go and see what's going on with zip codes. Give me 1 second so I can pull up this data, and here is the zip code information. In which zip codes? Going back to that entire Cedar Park area. Look at that, 1.7 dropping down to 20.6. That was one of the best performing zip codes. Going back to that comment of agents that were doing a lot of open houses, Ranch at Brushy Creek, Cedar Park, and all that, all of a sudden they're like, I don't understand, Avery Ranch, things were just on fire towards the beginning of the year. Now it's slowed down. The data certainly proves that. And then you take a look at 78726 doing extremely well. We just had the second best activity index. Y'all, the reason why we go over this information is so that you can pick the areas that are selling. You can pick the areas where the buyers are acting right now based on pricing, based on availability of inventory. That is why we publish all this information. Any highs? Did we get any highs? We had one close to a high. That's going to be the 2.6. We've got a few lows right here. We've got 3.6. 3.6 is really struggling right now. We got up to a 41.5% activity index in February. Right now, we're at a very cold 11.8% activity index. That zip code has just hit a wall. Same thing with a 3.9. 3.9 is interesting. 3.9 was the number one zip code for the longest time, months of inventory. It is still the number one zip code, but right now it's the number one zip code with the highest year-to-date months of inventory increase out of 75 zip codes. So we've got quite a few zip codes that have hit a low on the activity index. You've got 4.8, 4.9. And a lot of you are saying like, well, what is driving this? Pricing. Pricing is driving this. As a matter of fact, I see a chart coming. If you all are interested, no promises. I might not do it. As a matter of fact, I'm going to say I'm not going to do it, but I'll probably end up doing it, but I'm not going to promise it, so I'm not going to do it. If you want like a matrix that is showing you the activity index as opposed to like the price and what's driving this, because we know it because we know these zip codes. But if that is something that interests you, send me a note, send me a text message, and maybe I'll be bored and I'll decide to put this together. So if I don't get a text message, I am not doing it. But if for some reason one person says, yeah, that'd be pretty cool, then I might do it. Okay. I might do it January 1st because I did promise you all that we're only focused on improvement this year, not on new resources. But I already broke that promise like 10 times, but I will not break that promise again. Let's take a look at a few more things. Can you explain the chart some more? Which chart? What are you talking about? This chart?
No, the one that you're talking about creating, you said something about the activity index, but then you also mentioned price, but then I
Yeah.
don't know.
Yeah. Just having a combination of pricing and the activity index. So, for example, you see how on this one, we have the activity index and months of inventory. I think it'd be pretty neat to have a pricing, like what's the price and what's the activity index? How does the activity index relate to the price?
Yeah, I do. Well, We already have the bifurcated market. Doesn't that also kind of explain the same thing, that
Well,
chart?
no, I wouldn't say that it does.
No.
All that does is just shows us which 25th percentile, the bottom or the top, how it relates to each
Okay.
other, not necessarily based on the forward movement of the market expressed in the activity index.
I do think that would be a good chart.
Yeah.
Now, finding it later will be the problem.
Oh no, I'm not going to publish it. I'm just going to create it as like raw text and just like, oh, here's the information. I'm curious. That's what it is. I just want to satisfy my curiosity of how is the demand right now related to whether it's the median price or the average price. And I might just do both of them. Sometimes median is better, sometimes average is better. So for me, it's more of like the curiosity factor. We know these zip codes. We can see that the higher end zip codes are dropping when you look at the activity index. And then the lower price zip codes are actually improving. And you can just see this right here. Even though you've got 26, I mean, 26 is a fairly high price zip code at 708 on the median price, but we've got all the data. See, the issue is not putting together the information. It really take me like 5 minutes to do this. So if anyone is interested, just send me a text message and I might do this. So those are the leading indicators, you all, on what's going on with the market. And we can see that zip codes that statistically or historically were outperforming the entire market. All of a sudden, we've noticed a big switch in those zip codes from the 17 to even the 78613. Let's take a look at 78613. There's another one, 78613, very close to 17, north of 17. That right there is going to be less than half of the activity index from just a few months ago. That was at 41.5% activity index. And right now we've got a 19.6. All right, I got one text message saying, yeah, I'd like to see that chart. So if you're typing a text message, you can just hold on to that. So I'll see what I can put together. Okay, so now I've got two text messages. I love it. So now it's almost like a must. I do not want to disappoint the two of you that sent me a message. We spoke about the leading indicators. Now it's time for us to talk about the lagging indicators. So let's take a look really quick on let's go ahead and take a look at some of the lagging indicators. We've got months of inventory. And for those who are in the 78701 zip code, you can rejoice knowing that we've got the lowest months of inventory in 1 year. So if you are working that downtown Austin market, you can just tell your client with the biggest degree of confidence, it's the lowest months of inventory. As a matter of fact, I'm going to create an article. The article title is going to be 78701 downtown Austin, lowest inventory in 1 year. Yeah, it's at 10.64 from 11, but it is the lowest months of inventory in 1 year because people are only going to read the headlines. They're not going to read the article. Like, wow, downtown Austin is killing it. Lowest inventory in a year. That is a true fact. That's what the data says. But some of the ones that do have the lowest inventory, and it's actually pretty decent, take a look at 78703 at 5.28 months of inventory. We're now back into, very much close to a seller's market territory, especially when we got up to 9.93 months of inventory 11 months ago. Now we're down to 5.28 months of inventory. So that's really good. Let's see another one. I don't even know what that other chart is. Let's take a look at another one. We've got 78737. That right there just hit a 12-month low on inventory at a really, really good, a very decent inventory of 3.22. We were up to 5.81 a year ago. So that inventory has collapsed. That's good. So we've got quite a few that we're hitting some record low inventory going back 12 months. Even 78746, we got up to 10.29 months of inventory. We're going to be close to half of that. What's going on in 4.1? Yeah, 4.1 just hit a wall. We're at 11 months of inventory. Nothing is really moving in 78741. All of a sudden, that just hit a wall when you look at that. The activity index in 78741 is 8.4%. And if you just take a look at all that's going on in that zip code, nothing's moving. Let me show you. Look at this. This is the activity index per price point and then per square footage. All of these reds means there's an active listing there but there's no pendings. Only active, no pending. Nothing is moving in that zip code. The leading indicators for 4-1 just hit a wall. Nothing is going under contract in the 78741 zip code, which is really interesting to see that because it is a fairly desirable area. You've got Southeast Austin, that's East Riverside, Montopolis, Pleasant Valley. And all of a sudden, that zip code just hit a wall. Nothing is happening there. We've got Lago Vista. Man, it's just very challenging Lago Vista right now. Well, let's take a look at pricing. As we predicted, we have a negative month over month on the average sold price. That is down $780. Take a look at the number of sold, 2,390 sold properties. That number is going to go up by just a little bit. But on the month over month, we are down by 19%. And that's going to be the second lowest on record for the month of July going back 25 years. Average sold price down by 0.1%. We are up year over year. We knew we were going to be up year over year. There's a big gap right there for us to bridge. It's up year over year. On the median side of things, we are down $4,900. We hit $440,000 on the median sold price for the month of July. That's down 1.1%. And year over year, we're negative on the median sold price. We are down we're down $5,000 year over year. Another interesting data point is going to be that sold to list price ratio. That's at 97.13. July of 2024, it was 97.53. Sellers were getting closer to that final list price compared to July of this year. And you can see that on the average sold price, we are down close to $100,000. We are only $1,000 short from a $100,000 drop on the average sold price. That's going to be at 14.57%. On the median side, we're at exactly 20%. $110,000 drop. 20% drop was just insane. It's amazing to look at it that way. Really interesting. A lot of people say, well, Dan, how does this compare to 2007? We can see that the market the last time around peaked December of 2007, right before the great financial crisis, and then the market started correcting. So we are 38 months into a market correction. Isn't that hard to believe? We are 38 months into it. We throw these dates around like, oh yeah, May 2022. But then we're like, wow, that's 38 months. That's a long time. When I take a look at December 2007 all the way to November of 2013, and that was like the duration of the national market correction, 38 months into it, our market, the Austin market, was down by 2.32. This time around, we're down by 20. It's crazy to look at it that way, isn't it? Insane to look at it that way. When we look at everything that's sold, we are up on the average. We're up $4,363, but we are down $5,623 on the median. The sold to list price ratio is exactly the same as last year, 97.3. Let's take a look at type of market really quick. Out of the 30 cities that we track, 16 are still in a seller's market, 6 in a neutral market, and 8 in a buyer's market. Let's look at a few more things here, and you can see the cities that are close to transitioning. Well, we're not going to notice more cities becoming neutral in buyer's market. It's usually the other way around. The data is really finicky between August and November because this is what happens. We start noticing an increase in withdrawn, and we have less properties entering the market because people feel like, I'm not going to list my home right now. I'll just wait. So the number of active listings are going to go down, but now you're comparing the number of active listings to what's sold within the past 90 days. What is that going to give you? You're taking a leading indicator, which is the active that is pulling back, and you're comparing it to a lagging indicator, which is sold, which is at the summer high. That's going to give you a lower months of inventory. We always notice the months of inventory backtracking, dropping between August and November. Well, then we start getting a few more listings entering the market, but now we're comparing it to properties that sold when? August, September, October, or September, October, November. Less property selling, months of inventory starts picking back up. For me, months of inventory is almost like the price per foot. Everyone wants to talk about it. Everyone wants to make a big deal, and it's half the time pretty worthless. Like, really. I hate price per foot. I hate it. It doesn't take into account the view, the lot size. It doesn't take into account 1,000 factors related to the property. It is 20% of the square footage, a big old huge game room on top of the garage that's cheap square footage. Well, I'm not going to give it a value of $200 a foot. I'm going to give it a value of $75 a foot. But that doesn't get expressed on the price per foot. People usually just take the median price per foot, average price per foot, multiply it by the size of the property and say, well, this is the value. Personally, I think that's ridiculous. I think that's insane. It's going to oftentimes either cause you to overprice the property dramatically or underprice the property because the property may have that $1 million view. It may have that intangible like a swimming pool, a spa, a beautiful backyard. So I'm not a fan of price per foot. We have to publish it because some people are obsessed with it. No difference than the months of inventory. We have to publish it. We do look at it. It is important. But that is not going to give you the information that you need immediately. That's going to be the activity index, the pending divided by the active plus the pending. That's what's going to give you that up-to-date, immediate information where you can educate the client and help the client make a decision. On the zip code side of things, out of the 75 zip codes that we track, 40 of them, 53%, are in a seller's market, 20 are in a neutral market, and 15 or 20% are going to be in a buyer's market. Last week was miraculous when it comes to rates. There's no other word that can describe last week other than it was the week that we needed for mortgage rates. As a matter of fact, let me show you something. Remember that cap rate resource that we put together? How many zip codes do you think are now over the 6-month T-bill yield? Because that right there is the metric that we use, because investors use it, on whether an area is becoming more attractive for investment. Now, we've been hovering around the 8, 9, 10. Let me show you now. Because the yields went down by so much, we now have 18 zip codes. The cap rate for 18 zip codes are now over the 6-month T-bill. That is amazing. We've got 2.4, 2.5, 4.1, 5.4, Del Valley, 78617, Manchac, Manor, Spicewood, Hutto, Jarrell. Incredible. Buda, we've got Kyle, San Marcos, Cedar Creek, Elgin, Smithville, Burnett, Dale. 18 zip codes. What does that tell us, y'all? It's a matter of time. If the market corrects another 5 to 10%, that number goes up to 25, 30. That means that half of the zip codes are going to yield. But this is all median, right? We take the median price, we do the average tax rate, the average tax, we do a 5% maintenance. That's going to give us the gross rent. And then we can take a look at we use the gross rent. We then get all of the expenses. We're going to get the net operating expense, and that's going to give us the cap rate. We're going to be at 30, 35 zip codes where the cap rate is going to be over the 6 month T-bill. This is really encouraging. We are seeing more affordability in our area, and with that, we are going to see a higher demand for properties in our area, which is what's already happening. The one factor that is contributing to that lower new listing to pending ratio is we're also getting a ton of new inventory. But take a look at what happened over the past 5 days. Just incredible. Absolutely amazing. Let's go 1 week. Right now we're 4.199 on the 10-year. Look at it's crazy. This is the lowest yield that we've had going all the way back to May. Really, really encouraging what happened on Friday. I don't like the reason why it happened is because the jobs report was just absolutely terrible, especially the revision. A lot of the jobs that they said occurred, it really didn't occur. But keep in mind that I believe that like 43 out of 45 BLS reporting cycles, they revised downward. Remember last year, they revised it by over 800,000 downward. So they've been wrong. I have no confidence and didn't a year ago, didn't 3 years ago. I have no confidence on the reporting of these numbers, whether it's inflation or whether it's labor. They are so wrong. They've been wrong. Do I fall in the camp that's like, this is all political? Well, no, because they've been wrong for like 40 out of 45 reporting cycles. Like they're 90% wrong regardless of the administration. They're just wrong. Now, maybe it's because they're saying, well, people don't answer their phones. Well, then figure out a better way to measure this information. Well, bottom line, they've been wrong. But the revisions were terrible, and that caused a little bit of panic in the market, and we are the beneficiaries of that panic in the market because it does drive the demand for very safe yields. And the other thing is that it puts the Fed in a position, if you've got worse job numbers, then it puts the Fed in the position of having to lower the overnight lending rate in September. September, what is it, 17th, 18th? So then let's just say that they lower it. And then let's just say that the 10-year Treasury yield then continues to drop. Well, if it continues to drop, that means that the price went up. So yeah, let me buy it right now where the price is high. So then I can then sell that asset later on when the price is even higher, when more people are demanding that asset. You can see behind me, take a look behind me, the momentum is, continuing. We're down 1.9 basis point right now. But it was amazing what happened on Friday. On Thursday and Friday, it just plummeted, which is really encouraging. And that's going to give us rates that are FHA very close to that 6%, 6 1/8. And we continue to see some improvement on mortgage-backed securities and also on the 10-year yield. We could very well see FHA, based on the momentum that we continue to see right now, we could see FHA at 6%, maybe even under 6%. And I'll tell you right now, that'll be miraculous for our market. That will absolutely cause people to enter the market where otherwise they would not have entered the market. Conventional still a little bit high at 6.75, but as this momentum continues, I absolutely can expect and do expect an improvement in rates. So let's take a look at what we are going to see this week as far as economic news that may affect rates. Let me go ahead and just click on this week. And the equity market's just doing really well. Wow, it's amazing. Up 1% on, I mean, just really incredible. Dow Jones 1.05. You got the NASDAQ, that's up 1.65. That's just incredible. Factory orders down. Here we've got the bond auction. Oh, wow. Look at that 6-month bond auction. Down 3.98. That's amazing. That means that tomorrow morning, forget 18 zip codes under the 6-month T-bill. Tomorrow morning, it'll be 21, 22 zip codes under the 6-month T-bill because of that bond auction that happened at 10:30 a.m. We've got import, export. We've got a lot of manufacturing data tomorrow. On Wednesday, we've got mortgage applications, crude inventory. We've got some FOMC members. We've got the 10-year auction. That's going to be noon on Wednesday. That's pretty important. We're going to have more jobs data out, productivity. That's going to be on Thursday. Consumer credit, balance sheet. And we've got a lot of commodity data on Friday. Not the most consequential week. Economic optimism is going to be pretty big tomorrow. We've got ISM, stands for the Institute of Supply Chain Management. That's fairly big. I mean, you've got, some 3 stars right there, especially when you look at Purchaser Manager Index. That's what PMI stands for. But more so on the pricing side of things, that is an inflation indicator. That's what's going on this week. Next week, very big week. Next week is going to be huge. So let's talk about best case, worst case. Best case scenario, inflation data comes in either at forecast or flat. If that comes in, the bond market is going to love that. If it comes in better than that, the bond market is going to absolutely love it because it's going to put pressure on the Fed to lower rates. That's best case. Worst case scenario, inflation comes in way hotter than expected, way hotter than forecast, hotter than previous. In that case, the Fed is like, you see, I told you, that's why we're not lowering it. Tariffs are causing inflation. Here's the inflation data. It's proving what we've been saying. I'm glad we were cautious. And the bond market's not going to like that. So this week, not the most consequential week. Next week, very consequential, especially on Tuesday. We've got small business optimism. What's going on Monday? Is Monday a holiday? Is August 11th a holiday? Is August 11th a holiday? Because they don't even have Monday here. What's going on? August 11th holiday? I didn't even know it was a holiday. It is the National Sons and Daughters Day. Yeah, it's not a holiday. So I have no idea why they're not reporting anything on the 11th. So be it. They're not. And then we've got Friday, more inflation data coming out on Friday. So it's going to be a really big week next week. Not so much this week. I'll certainly keep you all posted on exactly what is going on. Does that take your child to work day? Yeah, we'll see. Maybe it is. Huge week next week. Not so much this week, but next week. Huge week next week. And you all, that is all that I have for our Monday morning touch point. It is 10:58 this morning. We want to honor y'all's time, keep it at exactly 1 hour. This right here ought to give you all the information to equip you so that in turn you can equip your clients to make the single best decision for them and their families. If you do have any questions, comments, concerns, criticisms, or complaints, please feel free to reach out. Otherwise, have an amazing rest of your day. I will send you all this information and I will chat with you later on. Thank you all so very much for joining, and I will chat with you later.